Hi, and welcome to the Stockscores Market Minutes for May 16th, 2014. Last week we talked about having patience with your winners. This week I want to talk about not having patience with your losers. It's inevitable that you will take losses. Every trader will have some losing trades, and therefore, going into the trade, you need a plan for what you will do when you are proven wrong. You need to know the price point where the market will have proven you wrong, and use this point as a threshold to take the loss. Now, it's also useful to use this price point to define position size. Now, let's take a look at one of the trades that we talked about last week. If you remember last week's video, I showcased some of the trades that I did as simple swings that week. And one of them was this one, VRNG, Vringo Incorporated, which was breaking through resistance at the point there where you see the green and red horizontal red lines starting as they move from left to right. Now, on that particular day, it met the criteria of my strategy. Going into the trade, I was buying that trade at $4.22 roughly, and buying it just under $4.10. So going into the trade, I knew that I had about 15 cents a share in risk. That means that if I buy 1,000 shares, my risk is $150. If I buy 10,000 shares, my risk is $1,500. And I know that because I'm going to take the loss if the price falls down below that price. Now, why did I draw the red line there? Well, the idea is that the green breakout candle at that moment happens because there is some new information coming into the market. And the basic thinking is that if the market were to pull back and close below the floor price leading into that breakout, then there is something wrong. The stock is likely to move lower because the information that caused the breakout to begin with is incorrect. And therefore, I plan to sell if it falls back below that floor, which is exactly what happened the following day. You can see first thing the following day, there was a breakdown. I exited the trade with some slippage. I didn't actually get out until about $4, but look at what happened in the days that followed. That stock lost 25% of its value, highlighting why you have to take that small loss when the market tells you to. All right, let's get into this week's analysis. Here's a chart of the SPY. The market tried to make a breakout this week. Early in the week, it had closed at new highs, but it failed to hold that new high close, and as a result, we're still basically underneath resistance on the weekly chart. Now, many people were calling for, a big correction this week because of some of the big down days that the market had, but the chart doesn't really support that. The upward trend line is still in place. We do have low volatility right now, and so that is, typically comes right before you see a big move in one way or the other. Until that upward trend line, the green line that I've drawn, is broken, I wouldn't be too worried. The market could just as easily break higher and continue in that long-term upward trend. Given that the market is close to its upward trend line, however, it does deserve some caution. Toronto Stock Exchange, similar situation. It is in an upward trend and right at its upward trend line. On the balance of probability, it should continue that upward trend, but if the upward trend line is broken on the weekly chart, then I would run for cover. TSX Venture had been trying to bottom and build some momentum. We had a good show of strength through January and February, but this market seems to have cooled off yet again. I don't know that we'll necessarily see a test of the lows, but this week's performance is an indication that more weakness is likely to come. Treasuries have been really rallying higher, and I think much of the reason is because so many traders were expecting the U.S. Federal Reserve to taper their market activities, their buying of bonds in the U.S. bond market, and as a result they were shorting bonds, and now with lack of a breakdown in bonds, they are having to get those shorts covered. It's a bit of a short squeeze in the bond market, and that is helping bond prices go up, which takes the yields down. If you're a consumer and you want to borrow money, then that's a great thing because, of course, interest rates are relatively low. US dollar is trying to break its downward trend line after trying to break down through support the previous week. You can see last week it went down through support but came back to close strong, and this week a bit of a rally but hasn't really made that solid break of the downward trend line. So I still want to be bearish on the US dollar, but with some caution because there is an indication there that we could see a break higher. Gold is in a pretty narrow trading range right now. What it has going for it is that we're seeing a build of a rising bottom. You can see that the low of the past 2 months is higher than the lows of December into January. What the gold market has going against it, however, is the fact that it is in a downward trend. I've drawn that downward trend line in red, and that is really just the pessimism that hangs over the market for gold. And until that pessimism is broken, I want you to remain relatively bearish on gold. Oil is still stuck in this long-term sideways trading range. It bounced back from some selling pressure of the past few weeks this week, and it may try to retest that upper envelope of that pennant pattern. Fear is really at an all-time low. I would worry that there is some complacency in the market. You can see that the VIX is really moving to new lows at an accelerated rate, and that tells us that investors aren't insuring their portfolios against a big catastrophe with the use of options. And that's what this VIX is all about. And that implies that maybe they're not showing enough concern for a potential correction. So sometimes, although this chart tells us that there's no fear in the market, you have to also worry that when it gets too low, investors are complacent, and that can be a setup for a big correction. Still no sign of fear coming into the market. So bullish on US stocks long term, neutral short term. I'm a little worried about whether that upward trend line is going to get broken. Canadian stocks, same ratings, bullish long term, neutral short term. It is also threatening its upward trend line. Gold neutral in the long term because it is trying to stabilize with that rising bottom, but until it can break through that downward trend line, I want you to be relatively on the bearish side of neutral. Oil neutral in both time frames. It is essentially gyrating sideways below resistance, above support. Not a lot of excitement, but stability is good. The oil company stocks are doing well. US stocks attempted a breakthrough resistance this week, but that failed, although the upward trend line remains in place. Treasuries are at resistance and should turn lower. That's something important to watch in the upcoming week. Canadian stocks are in their upward trend still, but some sectors, like energy, are overbought, and I worry we're going to see some profit taking in that sector. Gold and oil are not showing any strong directional tendency, but deserve to be watched closely. Well, that has been the Stockscores Market Minutes for May 16th, 2014. Have a great week in the market and trade well.